Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and it is Friday, March 21st. So we have another episode of Investment Friday for you. I'm here with my good buddy, Brad Haines, Chief Investment Officer of Juncture Wealth Strategies. Hey, Brad, how's it going?
Doing well. Just trying to survive volatility in the market and the media onslaught of negative news.
Yes, yeah, and the many client concerns and questions that we're getting internally, and doing this is when we earn our keep, I think, for the
Oh,
most
for
part,
sure.
right?
Yeah, for sure. I mean, a lot of times, clients either have an overly optimistic or overly pessimistic view of the economy, and they want to trade that way. And sometimes that doesn't work out quite as well as they would hope. So our job is to sit back and go, okay, I understand what the media is saying, what you're hearing on TV and in the news and stuff like that. Um, but the financial markets may be telling you something a little different. And so we need to be paying attention to both of those.
Yeah. So one thing from today, so we want to talk about a little bit. We had on again Friday, March 21st. This is actually today. We're recording it on Friday. There's an event called Triple Witching, and so you might see some news articles about that if you look on, if you have an iPhone and you have your stock app and you go on and you open it up and what does that mean? What is triple witching? So tell us what that means and why it's driving the volatility for today.
Okay. Triple witching is a fun day we have 4 times a year. See, it's the third Friday in March, June, September, and December. And effectively what it is, it's the expiration of stock options, futures contracts, and options on futures contracts. Okay. So all it really means is a lot of derivative contracts are expiring. And so there's a lot of underlying settlement trading and those types of things, and hedging and rehedging and rolling, and that happen in that day. To give you an idea, today it's estimated $4.6 trillion in notional value, which means that's the value of all the contracts added together, are going to expire. So there's a lot of money movement beneath the surface. So these days are usually pretty volatile, which as we've seen this morning so far. But it really doesn't necessarily give you an indication of anything other than that trading settlement, that settlement trading below the surface. It's not necessarily it doesn't provide a lot of information in terms of, hey, where this stock is going to be trading next week.
Yeah, so we're saying 4 times a year, third Friday of March, June, September, December is when these three types of futures contracts or options contracts all expire at the same time. Um, Slightly more education piece. There are other days where option contracts expire. It's just that these 4 times in the year are when those three different types line up onto the same day, right?
And the volume of those three are far higher than those other days.
Yeah. So that's why, again, it's almost like the market's getting stirred up, right? It's like,
Yeah.
oh, we're just having a lot of churn today. It doesn't mean there's no fundamental thing wrong. It's just really active.
Yeah, it's just really active. I mean, you know, I've seen triple witching days that go up a lot, and that's just as wrong as if it goes down a lot based on so it's just oftentimes it gives you weird volatility in all these different areas, and none of it has anything to relate to earnings or economic factors.
So if you're concerned about today, and it's also the market started down pretty far, it came back up to around zero. It's kind of backed off a little bit. We might end a little negative. We don't know. We've got another few hours of trading left to go. Um, but overall, this is a day that you can just kind of write off. Not if you didn't have options contracts that were expiring, there's nothing for you to really worry about today. It's not a big deal.
No, but I will say that if we end negative today, we're going to be ending negative for the week, which this is, I believe, the fifth week in a row that we've had a decline in the S&P 500. You know, we pulled back to a correction territory of 10% as of last Thursday, rebounded a little bit, and now we're kind of in that down 7, 8, 9%, depending on what moment you look at it. So again, equities have sold off. If you have excess cash, oftentimes if your time horizon is more than 5 to 10 years, this is a great time to start putting a little bit of money to work. You don't have to put it all to work all at once, but you should be adding just a little bit here.
So let's talk about that a little bit because in our investment meeting on Wednesday afternoon, you shared a graph that was super helpful. So, as usual, when we share any graphs, we're going to talk through it as best as we can so the listeners can visualize. Hopefully, if you're a person who can't visualize at all, which there are some of us, I can visualize things, but some people are like, no visual representation in their mind's eye. Go to YouTube, go to the Expansive CEO YouTube channel, and we have this uploaded on YouTube so you can see the graph as well. So that's for everyone. So Brett, Leah, let's talk about that. Let's talk about the sentiment or the overall, like people are a little bit concerned right now.
Yeah, and with good reason. Um, People are concerned. So the graph I'm showing you right now is it's a measure of U.S. investor sentiment. It's put together by the Association of Individual Investors. Okay, and essentially what it is you take the bears, or excuse me, you take the bulls, the investors who are bullish on the market over the next 6 months, and you subtract it from those who are bearish on the market for the next 6 months. And it gives you a net indicator, right? So a positive value on this chart, which is that 0% mark, means you're neutral. You think it's going to be fine, but it's just neutral. If it's over, it means you think we're in a bullish market. We think you're going to be higher a few months from now than we are today. Bearish is exactly opposite. You think 3 months, 6 months, 9 months from now, the equity market's going to be lower than it is today. So again, really important just to understand how this is constructed. You can see that this is a 10-year chart. All right. The gray bar here is COVID recession.
So that's in
All right.
2020.
So in 2020, there's a gray shaded bar, vertical bar that gives you an idea is that's a recession. Okay. So you can see that in COVID, we got down to, negative 25 to 30% area. Makes sense. We were going through a pandemic. Lots of things changed on us. Then it rebounded to the positive levels, 22, 23. A lot of it was negative. And here in 24, it was very positive. And then early in 25, it has fallen from roughly 25% level down to a negative 36% level. Now, looking at this, it's really rare that we get down to this level of bearishness. Okay. So that's something to think about. Individual investors are very, very bearish right now, at least by what this survey tells us. Okay. Another survey is the CTAs, which is a commodity trading advisor. Now, these individuals manage futures contracts where they trade a lot. They trade based on what they think over the next short period of time, the US equity, bond, interest rate, currency, and commodity markets are going to do. So most of these individuals are trend following, meaning if the trend is bad, they're going to be short. If the trend is good, they're going to be long or positive. Okay. They're going to have positions. But it's instructive because it gives you an idea of what some professionals are doing. And you can see that they had a lot in the positive. Okay. Again, there's a dotted gold line at zero, which means they have zero exposure to equities, both positive or negative. Okay. They're out of equities. A negative number says they're short, meaning they think they're going to make money as the equity market falls in price. So the only time you go short is if you think the equity market's going to be trading lower and you can make money on a strategy doing that. Okay.
Mm-hmm.
Anything above zero, the positive numbers, is how much money they have invested in the stock market, meaning they think stocks are going up in the short to medium term. They think that the equity market's going to rebound. Well, just for the listeners, we've fallen from about 60 billion, little under 50 billion here at the end of last year, down to negative 36, 37 billion. So it's a big swing in a very short period of time.
Mm-hmm.
So we have one group of professionals that are very, very negative. And these individuals are very short term. They trade a lot, so they can position exactly as they want, okay, without any hesitation. And we have individual investors which have also shown that same experience of going from very, very positive to very, very negative, which means we probably have a number of those individuals who have sold or trimmed their equity positions already. Okay. So, not to say this is a great timing tool, but historically, this has been a decent time to get involved when we're this negative. Now, it doesn't mean we can't go further down on the equity markets, over the short term. What it does mean, though, is a lot of people are very nervous, and bull markets, in a saying, climb the wall of worry. Okay, that is a kind of a truism in the financial markets, a rule of thumb that has been stood the test of time for a very, very long time. And it's a mantra that you hear as soon as you get involved in the markets, that bull markets climb a wall of worry. Right now, we have a lot of worry. Okay, and so again, is this a precursor to a bear market, or is this a bull market that has had a correction? My guess, at least at this standpoint, is it's a bull market correction, not going into a bear market recession. All right. Stay tuned, because if that changes, we will change that and change our opinion on that pretty quickly. But right now, it shows that that a lot of people are very concerned. And when that happens, historically, generally, it's a great time to start adding some money to equities if you have cash on the sidelines, or rebalancing out of bonds into stock if you have a more balanced portfolio.
So one of the things that I wanted to point out too with this chart, and the other one, that they track very similarly, right? They're not exactly the same, but they're very similar between those two. And if you had, so what you were just saying, right? Like when investor sentiment is this low, and when that many professionals, so that this first chart, investor sentiment, right? The second chart was actual shorting of the market by professionals, right?
Correct.
So when we have those two things agreeing with one another, that sentiment is very low, so we're going to short the market. The professionals are shorting the market. The individual investors have low sentiment. That typically is a good indicator that the market is getting to the point where it's about sold off, right? Like that's it. I've used this term before, and I need to find a better one. Like when there's blood in the streets, right? There has to be a better term than that. But
Well,
when it looks bad.
you're quoting Sir Kenneth Galbraith, who was a phenomenal investor, and that was his term. Is when he invested, there was literal blood in the streets because of revolution. So
Yeah.
he was the ultimate value distressed buyer. So, but if we want to liken it unto our situation, yeah, I mean, if things get a little hairy, if people get pretty negative, it stops people from investing, and it has people trim. Well, at a certain point, everybody who's going to sell has already sold, and it doesn't take a lot for buying power to come back into the markets. So,
Yeah. And the other piece I wanted to mention about, I mean, we can see it in 2020. We can especially see it in 2022. There was a lot of up and down. So we hit a down, came back up, down again, right? So we did this up and down because there was a rough few months. And so you might feel like, let's say you catch this downswing and you get that cash to work right now, and we go back up, we rally back up a little bit, and then it comes back down to the same level, right? You might be in the camp that says, oh, see, I made a mistake. I shouldn't have done it. I'm going to sell. That's not the play, right? It's when you have the chance to invest at a low point, you want to ride it out. You want to keep invested in any way that you can, because over time, even if we have a seesaw, while you're feeling a little sick while we're going up and down, eventually that bull market's going to gain traction again, and you bought in at that low level. So you're going to ride the entire wave up versus waiting till things look better and jumping in you know, when we're already fully on an upswing. So this is the data representation of that seesaw, right? Especially this investor sentiment one, right? It's like things are good, things are bad, things are good, things are bad, things are good, right? It's like it feels sickening to write it,
yeah,
but
yeah,
we come out
yeah.
of it.
I want to correct my prior. I attributed that quote to Kenneth Galbraith. He did not say that. I apologize. Baron Rothschild, the British banker and politician, is the one who said that.
Okay,
So he said in quote, buy when there's blood on the streets, even if the blood is your own.
that's it's dark.
That's a cheery, yeah, it's a cheery Friday saying. But again, back in the day, I mean, when revolutions were happening, that was, in his time period. One of the things that people have asked me over the past week or couple weeks, really past month or so, has been, how do we know this isn't a bear market? How do we know that this isn't something that's going to be bigger where, we go down 20 to 50% in the equity market? And that's a great question. How do you determine whether this is just a correction within a bull market, or this is the inception of a bigger correction that's going to go into a bear market, possibly because we're going into a recession? That's a great question. One of the things I look at, not only in positioning what we just showed you in terms of, you know, investor sentiment with individual investors and certain institutional investors like the CTAs, I look at I look at the St. Louis Financial Stress Index. So one of the things that we do is I want to see how much distress is within the financial system. Okay. Is it overwhelming? Is it starting to become problematic? Because when uncertainty within the financial markets or the equity markets or bond markets starts to bleed into other areas that impact corporate financing, real estate financing, consumer spending, that is where we need to find that transmission. And so one of the things I look at, the St. Louis Federal Reserve Bank creates this index, and it's on a weekly basis. They update it, and it measures all 18 different weekly data sets that measure stress within the financial system. All right. And right now, it does not indicate any amount of stress. In fact, it's still below average in terms of stress. So combining low stress in the financial system with a pullback in equity prices, even though equity earnings on the tech side have continued to remain high and actually have been upgraded, even though the stock prices have come down, tell me that this is probably a correction. And so it's a good time to buy. If you have a little excess cash, you want to rebalance your portfolio, a great time to do so.
Well, let's talk a little bit more about the that R word, recession, right? It was kind of out of we were it was in the rearview mirror for a while. I'd say in 2024, we had such a positive year that people were like, "Yeah, it's great, everything's great, not really worried about that." And it started to surface again, like you were saying, as a concern because the forecast. Tell me if I'm missing this. But the forecast for Q1 is negative GDP. Is that correct still?
Well, the nowcast. So it's not a
Nowcast.
forecast. It's the yeah. So it's showing contraction. Although I don't think we're going to be in a contraction, but that's what it's showing.
And so to keep going from that, the historical definition of a recession, which again, there's been some debate around is that the correct definition? But the historical definition of a recession has been two consecutive quarters of negative GDP. But
That's a good rule of thumb. Yep.
right. And we don't know that. The thing being, we don't know that we've experienced two negative quarters until we've been through two negative quarters and we look backwards. It's a backwards looking measure, not a forward looking measure. We can't say, right, like you're saying, the nowcast is indicating there could be a possibility, but we don't know. We can't know. And so every recession that it goes straight back to what you said, the bull market climbs a wall of worry because when we are in that recession, when we know, when we are experiencing it, when we're at is that the nadir? Is that the lowest point or is
Mhm.
that the
That's
highest point?
right.
The nadir,
That's
the
the
nadir
nadir.
of consumer sentiment, and people are scared. They don't want to invest. They're worried, right? Okay, we're down 10. What if we go down 20? I don't want to invest. What if we go down 20? I don't want to invest. What if we go down 40? I don't want to invest. What if the whole system explodes or implodes, whichever. Um, so if you continue in that thought, you're never going to get back in. You're not going to come back in until that bull has marched its way up the hill, and then you lose all of that opportunity. So that's where I think this whole conversation is like really, it's kind of like nicely tied in a bow here, right? Like we've got a lot of volatility right now. We just hit correction territory. Or investor sentiment, excuse me, is very negative right now. Professionals are shorting a lot. We can talk about what that means a little bit more too, in case people are wondering or if they don't really know what that means. So we have all of these factors leaning towards, yeah, we are at a low point right now. So if you choose to stay on the sidelines until things look better, that's how you consistently miss out on the historical, 8 to 12% of gains per year in the market.
Ex- exactly. And we've all seen the data points, and if we haven't, please let us know, and we will send you the chart on these. Where if you miss just the top 20 days in the S&P 500 over a period of time, you reduce your return significantly.
Right.
And those days are really, really important. And oftentimes those come during corrections and bear markets. Those two areas have the strongest rallies. So we don't we don't want you to miss out on those days because that does harm your financial future. That does increase the chance of you not hitting your financial goals. And that's our job, is to help you hit those. Um, I'm trying to find there's a graphic I have somewhere um, where it shows the individual, it shows the investor during a market cycle,
Mm,
and what they say and what they do, and how it's very counter to what they should be doing because their emotions are in flux. And a lot of times we make emotional decisions, and investments, it's almost the opposite. If you feel bad, you want to invest. If you feel great, you want to probably trim and sell. Okay, a little bit, trim a little. Okay. And even though it's the hardest thing in the world to do, to have clients do that, we do it for them. But again, it, it's still not a great thing for clients to experience, because they're like, why did you sell out 10% in equities? Because you were 15% overweight and we needed to rebalance back to your target. So we sold, took some profits, and we put them in bonds. We put it in cash, we put it in other places that now it's not as much at risk. Um, and when the equity market's going up, that's a tough sell. That's a tough thing to tell clients. Conversely, when you tell them you're down 10%, put money in, no one wants to buy it when it's on sale. They all want to buy it when it's premium priced.
mhm.
So we have to help navigate those emotional responses.
Yeah, while you're looking for that, it's a good time to um, one, mention that you, Brad, put out a lot of really good client um, material, right? So if anyone is wants to get on the mailing list or wants to come over and talk to us, we do communicate with clients very, very regularly, so that you understand. So beyond just this podcast, which is great and I love it, but we put out things monthly, weekly, different times so that you can feel confident that we're paying attention to things. The second aspect that I wanted to talk about while you're looking is literal nervous system regulation. So a lot of what I do with clients on the planning side, especially working with clients who um, a lot of entrepreneurs, business owners, people who are more risk on in some areas of their life, a lot of times can be a little more afraid of market volatility with their savings because you're doing something risky already by being the maker and creator of your own income. So sometimes they want more safety on the other side. So I say that to say the the fear that can come up, the worry and anxiety that can come up when the market is gyrating, it really does come down to being able to regulate your nervous system, regulate your emotions around this topic, to have the experience that I'm going to be okay. And actually, this is a really good time to buy. How do we get to that place? Is through practicing and experiencing it and being supported through it. So I even go as far with my clients. I have something that I call a money story guided meditation that I take people through to really understand where those fears are coming from. Because a lot of times it's actually from your childhood, from your earliest experiences with money, your caregiver's experience, um, security, safety, stability. That really shapes our worldview and then our nervous system um, imprint of how we're going to respond to financial stress in the future. So it is, while we talk a lot, especially on Investment Fridays, we talk a lot about the economic impact and the logical and the trusting in professionals when you have a hard time regulating your own emotions. It is, in my view, a combination of both that we need to understand where our fear and stress comes from and be able to heal that so that we can then make a new choice. And if that choice is, I still don't want to understand all of this stuff. I still want to hire you to like do the thing. That's most of our clients because they are good at other stuff. So you do the thing you're good at, but it really helps. Um, it really helps give you that balanced emotional response to the things that are happening, where you can focus on what do I do for my business and how do I move through and find the opportunities while I'm feeling confident and calm about my investments and my cash position. That is the actual place where most of my clients are right now. We're looking for opportunity. We might have to pivot in business, but the cash position, the investments, that stuff feels that is my safety. That is, I'm good. So I just thought I would share that.
Yeah, no, I think that's exactly right. I mean, I'm going to share this. It's not the one I wanted to find, but it's good enough. It'll share. So can you see my screen?
Yes.
Okay. So this is the quote unquote smart money where it just starts getting invested, right? Starts to get a little traction. People start to hear about it just a little bit on the peripheral. One, it has a little bit of pullback. Two, this is where the public starts to get very invested into it, right?
This chart is, imagine a single stock, like one company.
Yeah. And it's like the life cycle of the price of the stock. Okay. And so early on, we call it the stealth phase, where a lot of smart money who does it professionally find these companies and invest in them. Okay. And they do okay. Not fantastic, but they start to get a little traction, and then it becomes more aware of institutional money. So the bigger endowments, the bigger money, mutual funds, ETFs will start to get invested. It has a little bit of a pullback during that time, okay, which always does in the early part of a life cycle. But then it starts to go back up. And once it goes back up and breaks its higher prior high, the public starts to become much more aware of it, whether it's their unique business strategy, their unique product or service, their technology, something grabs the media's attention. And so individual investors start to become very aware of what's going on in this company and they start to buy in. And they start to buy in a lot. The price continues to rise for the stock. Everybody gets really, really excited. Then it goes to greed. Okay. Then it goes to completely delusion, which if you think about, this stock will never go down because of the great market it has ahead of it. It's growing a whole new field. Um, there's a lot of individual stocks you can put into this. They can't go down. They're so innovative. They're so smart. They're doing so many well. That is when individual investors are deluded into thinking that this is a more than just a company. Then you go into this, it's a new paradigm. And I swear this term is used every single time at a top that I can see, almost every single time that I've been involved in 30 some odd years of managing money. Then starts to have a pullback and people get into denial. Okay. They start to deny, well, it's a good time to buy. It's a good time to buy. Yeah, it could be. Bull trap. It pulls back a little bit. It has a really good rally in there. Okay. Well, that's the return to normal. People think it's going to go straight back to its highs. Well, maybe not. Okay. Well, then it starts to fall in price. Fear starts to take over. Okay. And then this capitulation, meaning people just give up. They stop looking at it. They stop looking at their statements, all of that stuff. When it gets below this last area, this is how you know an equity market is at a below is at a low. Is its complete and utter despair. with all the investors. They're like, yeah, I'm going to start doing something else. Like I'm going to start focusing on other things. They've either sold, they've already, the people who are going to sell have already sold. The people that no one has bought yet, and so it's really despair. What I would say is, oh, hold on, right here, buy. Okay, utter despair. All right, and this is for any individual stock. This is for stock markets in general. This is when you buy. Okay, we put a, you know, well, I better not say that. So, we've done some investing like this where we try to take advantage of things that are so beat up that the investors in that are in that despair mode. Um, we try to stay away from this, but we try to get involved here. Okay.
Hmm.
So what I would say is most clients uh can buy here and they usually sell here.
So on the chart, if you're listening, they buy when the enthusiasm is starting, and then they sell when the capitulation is happening and things are on the way down. So you've
Yep.
experienced a lot of growth. Maybe you've experienced the like that stock growing 20, 30, 40%. You're like, "Yay, awesome." And then when it starts going down and now you're down 10% or down even 5%, you're like, "Oh, I get rid of it. It's going away."
Right. That's exactly right. Neither one of them are correct. You know what I mean? So it's like this is where we try to work with clients and try to reverse this. Okay. Because as a professional investor, we tried to invest here and in the despair mode.
And so
And
in the
then
awareness phase and in the despair phase.
and we trim here.
Mm-hmm. At the greed, new paradigm, delusion.
Yeah. I mean, if someone starts to talking about the company is so great because of and it can never go down, that's the time I know I'm in this greed, delusion, new paradigm situation. So it's something that I want to really back off from quite a bit.
And we've seen that, we've experienced it with a lot of people. I mean, there are quite a few companies. We don't need to name any um, right now, but there are definitely some that you can think of in your own brain. If you think of companies that are led by a very charismatic figure, and the charismatic figure is the person that is like, it's always going to go up because of the person. That's going to be that's you're going to follow exactly that same chart that we just saw.
Yeah,
There's
that's
if there's
exactly it.
if there's like a singular reason, or I'm never going to sell because it's gone up for 20 years, so it's always going to go up. That's where, as professionals, we've experienced that with clients of like, hey, we really need to trim this position, take some of these gains off the table and put them elsewhere, right?
E- Exactly. I mean, it's something where I've seen people lose. I've seen people make and lose fortunes based on that criteria. Okay. Whether it's they have an individual product that's so amazing or the market itself is growing so much, their addressable market for their business is growing so fast that it can never go down, or like you said, a charismatic leader. Any of those are usually never a really good indicator of, well, it's an indicator that it can go up in value, but it also comes down in value pretty hard too. So it's something that you need to just keep in mind and understand that we use these times to intelligently rebalance our assets so that we don't take on too much risk, that we can garner and protect our gains and and do those types of things. It's a pretty simple strategy, but very few people actually do it.
Right? It's simple but not easy. Is the way we'll put it.
Correct.
It's one of those, right? Like when
Very
you
difficult to do.
yes, especially even more so than, some of the other simple but not easies. It's one of those that it's like because you have to overcome the fear or the anxiety to do it yourself, right? To like, okay, I'm gonna go. I feel like I want to run away from the stock market, but I need to actually be investing now.
Yeah.
Or I feel like the stock is never going to go down, but I've already made 35% on it. I'm going to trim it somewhat, right? Like it doesn't feel intuitive to do. So you're going against, um,
And I want to address something like, I don't know if any investor here has heard of a black swan. Okay. A black swan is an event that no one sees coming that's really impactful, right? So for us, let's say the equity market sells off 50%. Okay. And there's a lot of investment managers out there that will make a lot of money marketing certain aspects of being able to avoid it or the like. Okay. Or they'll come up with all these sayings, there's a couple very popular authors that have really made a lot of money do this. And it's important to understand that, yes, there's things you can do as a professional money manager to offset some of that risk. But as a client, it's important to understand to remain involved in those areas. Okay. You don't sell out, right? So at Juncture, we obviously have our hedging protocol that we attempt to offset in a very large market downturn like that. We try to offset half of that volatility. However, oftentimes those proponents of you know uh, selling out of the market or what have you, those authors have a bias because they don't take the full time horizon of the returns. They just take the most negative.
mm,
Okay. They don't take the time horizon that they don't take a look at that the average individual has a time horizon of 20 to 40 years. Well, if you take it on a time horizon of 20 to 40 years, that 50% pullback may take a long time to get back. Let's say 10 years. Well, you still have 30 more years, 10 to 30 more years of investment opportunity to keep going, and to build that. So when you hear about, black swan events and you hear about trying to mitigate and manage those downsides, you have to understand that they are looking at a short-term time horizon. They don't expand it to more than 10 years worth of data. Okay. And that impact. So it's really important to understand that as an individual investor, you're not an institution that has leverage. You're an individual investor. You can use volatility, like in those times when it's down quite a bit, to actually add money during those times and let that money grow for you as well.
yeah. One last thing I'll say, we had, a client recently who just had a portion of their account that transferred it over from somewhere else, was not under our management, but it just was not invested. It was like a third of the account, just not invested at all. It was just still sitting in cash and hadn't been put to work, which was unfortunate from last year since it was, a big year. But that meant that we were able to buy in with that money when it transferred over. We were able to use that cash that was sitting there and buy in at a 10% correction. So,
Buying cheap. Good job.
but right, amazing, great timing to move that account over and get it invested. I say that as a reminder for everyone, and I'm going to say this literally for everyone: go and check your investment accounts and see if you've got money sitting in cash that you didn't know was there. I can't tell you the amount of new financial planning clients that I get where when we're gathering their assets, they go in and look and some literally an account from a 401k from 5 years ago has been sitting in cash for 5 years.
Yep.
And I'm like, well, I'm glad we found it now.
It, that is way more common than people think. That is way, way more common because oftentimes we go from, employer to employer and we have two or three and we don't consolidate into an IRA because, we don't need to until we retire. And so people forget and they'll just it's more complicated to keep track of all of those accounts unless you have someone helping you overlook it and forcing you to do it, because
Right.
sometimes it's not the most fun thing in the world to do.
Yes. And then the other one, so along with that, if you have an IRA account, a traditional IRA, a Roth IRA, any kind of IRA, putting the money in as a contribution, and this is a really good timing because we're right almost at tax time. We'll say this again in the next couple of weeks. Putting money into an IRA is not investing it. Just putting it into the account as a contribution, it will sit as cash. You have to then pick an investment for that money. Otherwise, it'll just sit as cash. And again, I can't tell you how many times I've had a new client come in and their IRA, they're like, well, I've been contributing for years. And it's literally cash and was never once invested. So it's earned, $5 over the course of 5 years, which is heartbreaking again, because you're like, you think you're doing the right thing. You're doing part of it, but then it's not getting actually invested into the market. So
Yeah,
go look, just go check and check all your accounts, see if you can consolidate, remember where all of your investment accounts are and see what's there. See if it's invested, see if it's in cash. If you have questions, you can always come talk to us. Juncture X
absolutely.
squared, we are here. Absolutely part of what we do, if you can't tell from all the talking. So there's the invitation. And also, if you're working on your taxes right now, we'll talk about that a little more next week. What are the ways that you can still make some tax elections to reduce any tax liability? We'll talk about some of that next time before it gets to literal crunch time on taxes. Anything else for today, Brad? Any closing thoughts?
No, that's it. That's all I've got. You tap me out.
All right. Thank you for being here, and we will see you next week. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.